State Street's John Herrmann warned last month that the risk of an S&P downgrade of U.S. credit was serious. He made the right call, and now he's also saying that the risks of a recession are rising. John Herrmann is State Street's senior fixed income strategist, who's also a Bloomberg Best, one of the most accurate forecasters on the economy that we track. John, welcome to In Business. I've got an up market this Monday, and you're about to tell me that things are going to get worse, at least for the economy.
Yeah, well, you know, it's just a continued, ongoing warning that we're delivering. You know, our growth outlook has been below the consensus. Consensus moving lower. Consensus is now 2.1 for the third quarter. We would agree with that. We think consensus is a little too optimistic on fourth quarter and then for all of next year and possibly 2013 as well. What we're concerned is we see a lot of structural imbalances in the economy. They're persistent, they're ongoing, they're very difficult to overcome. We've delivered, you know, in excess of $1.7 trillion in fiscal stimulus so far, and we've only gotten about a $1.2 trillion bounce in nominal GDPs since that time. So these headwinds are very, very serious, and we think growth in the first quarter, for example, could be as weak as 1%. Ouch. So President Obama, exactly. So President Obama is just torn between these two issues, you know. On the one hand, to support the economy over the very near term, and then on the other hand, to devise a long-term deficit reduction plan and trying to make the two pieces coherent. So the challenges should be ongoing here.
You say a 30 to 40% chance of recession. It sounds like you're saying we're already in that contraction. It's begun.
You know, we're growing slowly. Again, we're growing slowly in the third quarter, and this is a quarter where we've gotten a lot of temporary benefits. You know, we've gotten relief from gasoline prices. We do have a ramp in automotive inventories, so we have a lot of temporary things supporting us, and yet we're only growing about 2% in real terms. So, you know, once we move past this point, the slowing in job growth and these structural imbalances, I think, just kind of slow us down here.
Well, give me a sense of what you're seeing in the funding markets right now. You know, there are some who said, get ready for the third quarter. We're going to see acquisitions by corporations. You're going to see the credit markets really start to loosen up here. And now you've got these macro issues, not only with the U.S. economy, but what's going on in Europe. Where are we in the funding markets in terms of their health?
Well, you know, we can look at a couple of areas. In terms of the interbank term funding markets in Europe, the strains there, in terms of the pricing strains, they've materially picked up over the last month to 2 months, and the pricing strains are actually above now the U.S., or what we call the FRA-OIS spreads here in the United States. So the strains there are a little bit more severe than we're seeing here in the U.S. But in the U.S., what we're seeing the strains is in the corporate high yield market, where the spreads have really dramatically moved out over the last 3 to 4 weeks, and they've moved out by over 225 basis points. And that should be a concern as well, and something that we'd want investors to take notice of.
Are we in this place now where European corporations are safer bets than European countries when it comes to buying debt?
You know, the same point could be raised in terms of the U.S. I mean, you know, you look at our top-rated companies, very strong balance sheets, you know, excellent cash flow, cash reserves. You know, I think this is a good point, and high grade corporate debt, I think, still is a spot where you'd want to put your money.
Mm-hmm. How long before the U.S. is able to regain its top credit rating, get back all of those A's, and be able to shake off some of this weight?
Well, you know, I think S&P has guided that on average it could take 9 to 10 years for the one-notch downgrade to be recovered. I think it's a little bit tricky here because, you know, right now we've devised a plan that's $2.3 trillion, and Simpson Bowles and S&P have recommended $4 trillion deficit reduction plan. Right. So we're still a little bit falling short of that. So it's not clear to me that the downgrades are finished.
Well,
so,
and you're talking, if you're talking about a GDP growth of just about 1%, doesn't that complicate the formula for the revenue that's going to be generated under the existing plan?
Absolutely. It complicates the revenue portion. It also complicates the near-term outlay portion where, we could be tempted to provide more relief to the economy and grow the deficit next year, for example.
Wow. John, it's good talking to you, even though you're telling us risk of a recession
I would say it's
right now.
I know, but I would say it's like a wake-up call, and we should, just be prepared for, for an ongoing discussion before the national election next year, and
yes.
We should all be very much in tune with what's going on.
No, important point, John. Thank you for making it.